Hey, Dan Passarelli here. Happy Friday. The word for the day is optimism, undying optimism. The market closing at new all-time highs. SPY at 677.26, up 0.8% on the day. And on what news? Well, on the news that CPI came in 0.1% better than expected. Still a full 100 basis points, one full percentage point over the Fed's target, but the market loves it, even though it basically means inflation is sticky. The market thinks that that is going to be enough to have the Fed say they're more aggressive on cutting interest rates. I don't see it. I don't see it until there's a new regime at the Fed, which doesn't come until May of next year, a good 6 months away. But that was the news that drove the market to be higher. Now, there's been some good news and some bad news. Let's start out with the good news. Let's get that warm and fuzzy feeling out of the way, shall we? So the one thing is that earnings have been blowing the doors off. Now, I told you 2 weeks ago that that is what I expected to see happen, and it's happening. 85% of the companies in the S&P 500 beat expectations, and they've been beating them pretty good. We've had a good number of companies really take off and start driving the S&P 500 higher, as we looked at yesterday when we talked about breadth and dispersion. Now, as far as the other things that are on my mind, we had this thing with Canada happen where they ran an out of context ad, and Trump retaliated by saying that he was going to cut ties or cut off negotiations with Canada, which in the past would have been something that made the market drop, but it didn't today, probably because I think the market maybe perceives this as just a temporary little blip that can be fixed and ultimately probably will be fixed. Also, we have this thing about the next month's inflation data. We got the CPI report. Even though the government shut down, we got the CPI report today because it's the September CPI report. But right now, all these government bodies that report data, they're not out in the field collecting data right now. So what that means is that come November, when the October data are to be released, we're either not going to get them or they're going to be just wild estimates. That means we're going to go another good month, maybe two, without data that drives the market and that helps make policy decisions. So that can cause some market gyrations, especially once in December, January, once we start getting that data back, the market recalibrates to the data that's been missing. That might cause some intense volatility. Now, with the VIX sitting here at 1639 right now, I was wondering today about going out and buying some straddles expiring in late November or maybe even early to mid-December to be able to capture some of those gyrations, but it might just be a little bit too early right now. That is not something that I have followed through with, but it's something that is on my radar. Now, another thing on my radar, as always, is the health of the wheel strategy, covered calls and cash cured puts. Those have been really, really good for a couple of weeks now, following a period where maybe about a 2-month period where they were pretty challenging because the market just drove higher with such force and velocity. driving to, I think, an all-time high P ratio, which is a measure of the relative value of the market. Basically, that's the most, right now it's the most overpriced the market has ever been if you take out any financial disasters. There's some definite things to be optimistic about, and there are some things to think about as well so that we can protect ourselves as much as possible in the market and become profitable traders and investors. I hope that helps. This is Dan Passarelli. Trade smart.